Hello guys and welcome back to the Babylonians channel. Today we're going to talk about Premier Finance. So Premier Finance is an options protocol and this is how their UI UX looks like. It's very clean, it's very simple, probably one of the best out there. You just select your strike price, your expiry date, how much you want to buy, and it will automatically calculate the price for you with this payoff calculator chart over here. So the difference between Premier and all the other options platform out there is that they offer American options. So American options, the difference is that you can exercise your options before expiry as compared to European options where you can only exercise your options at the expiry date. So the token for Premier Finance is Premier, and over the past 90 days it has run up a lot. Because a lot of people are expecting V3 coming out, and also their new tokenomics V Premier. Later we're going to talk about what are all the changes and also how you can buy options here, how you can underwrite options here. So here is a diagram that I have done up as usual. So it starts with the buyer. So buyers, you can buy calls or puts easily, and the opposite counterparty is people who want to underwrite options. So you can either choose to underwrite calls or puts. If you're underwriting calls, you are depositing your assets. So for example, if you're selling ETH calls, then you have to put ETH. If you're selling LINK calls, then you have to put LINK. But for put side, you just have to deposit DAI. So that's the difference. And if you're selling calls, you are basically selling the right for the buyer to exercise at a strike price if the price goes up. So for example, let's say you're selling 1,005, price is at 2,000, you have to sell at 1,005. So you want price to go sideways or go down, and if it goes up, it's your loss as an underwriter. And the same goes for underwriting puts. You want the price to go up, because if the price goes down, then you will be at a loss because you are taking the opposite side of the buyers who are buying puts, which gives them the right to sell at a higher price if the price goes down. So for underwriting options, you earn premiums, but there's a unlimited risk if it goes against the opposite direction. And also you earn some premier emissions for underwriting options. And the risk here is you could potentially lose your capital if the buyer is in the money, and there will be a 2.5% annual interest charge on your collateral based on the time period when your capital is used and to the date where the option is exercised. So 2.5% is charged on the underwriter side, and 3% base fee is charged on the buyer side who buys either puts or call option. And all these fees will go to the protocol fees, which 80% of them will be distributed back to the stakers. So this 80% will be used to buy Premier on the market, and then as a staker you are receiving Premier tokens as your rewards, and the other 20% goes to the treasury. So the thing about underwriting options in Premier is a bit unique because the underwriter's liquidity actually queues up based on a first in first out basis. So what does this mean? So for example, you can see that this is the first person who underwrites option, and this is their capital. So you can see this is the first person, and this is the second person, and this is the third person, this is the fourth person, and this is the fifth person. So whenever a buyer wants to buy options, it will scan through the first person who provides liquidity, and it will scan through as many amount of deposit until their options requirement is reached. So for example, let's say buyer want to buy X amount of options, and you can see that the first person liquidity will be used, the second person liquidity will be used, and the third person, a portion of it will be used. But if you provide liquidity at a later date, then your liquidity actually won't be utilized. You have to wait until the next buyer to buy the options. So this will get pushed in front. So it works like a FIFO basis. So if you're underwriting options, you might not earn your premium immediately until the buyer hits your queue. And also the underwriter's risk, the reward payoff is actually different. So what does this mean? Because as an underwriter right now on the V2 version, you don't get to choose what strike price and what expiry date you want to underwrite for. You are underwriting across all the ranges. So for example, the first buyer that buys here and the next buyer that buys here will be at a different strike price at a different expiry. And that will also mean the reward payoff is also different from the underwriter's perspective. And that's why the risk is actually different. So that is one of the disadvantage of underwriting right now. But in V3, they are going to improve this. So as an underwriter, you can specify exactly what strike range, expiry, whether you want calls or you want puts. So Premier Finance gives a lot of granularity for the underwriter, for the buyer, because you can specifically choose whether you want calls, whether you want puts, strike price, expiry, and all these small little details. So another thing to take note is this C-level option price, which is based on supply and demand. So every pool has a C level, and the higher the C level, the more expensive the options is. So as a LP, it's good because you are earning higher premiums. So how it works is quite simple. So you start off with a very high C level, and this will incentivize underwriters to come and underwrite options. And as more liquidity is added, the C level decreases. So as more and more people underwrite options, the C level will start decreasing, and as more and more buyers buy the options, then the C level increases. So you will eventually reach a point where it is sort of the fair value of the options based on this supply and demand. So this is called the utilization rate, which means like how many percent of the capital is being utilized. So you can see over here, for example, this ETH pool, let's see, this call is 91% utilized, right? So that means almost all the capital in this pool is being utilized by the buyer. And that's why you can see that the call pool price is 185% above market. So this means it's very, very attractive as a LP right now to underwrite this option because you are earning a very high premium by selling ETH calls. So generally as a buyer, you want to buy when the C level is low. And when the C level is low, it means that there's more supply than demand. And that's why the premiums are cheap. And generally as a LP, you want to underwrite options if the C level is high because you are earning fat, juicy premiums because the demand is more than supply. So they need more liquidity coming into the pool. So that's basically an overview of how the Premier Finance options work. So by buying Premier and staking, you are essentially acting as the house. So you don't bother whether buyers win, sellers lose or what. You just earn these 2.5% fees from seller and 3% fees from buyers. And then as a LP, you can choose whether you want calls or puts. Basically, if you are bearish, you should sell calls, and if you are bullish, you should sell puts. So how do you buy options? It's very simple. Just go to their platform and choose which chain you want, and then choose which options you want. So as a buyer, you want to be buying something that is like this below market, right? So you can see this is not good to buy because it's too expensive right now. It's good to underwrite, but not good to buy because you're buying 185% above the market price. So for example, if you want to buy calls or puts, just select the strike price, expiry date, and it will automatically calculate all this price for you. So let's do one example. Let's say link calls. So you can see, let's say I buy $7, expire at 20, and you can see that it automatically calculates the total cost for you. And you can see this is the C-level adjustment, the size adjustment, the protocol fee, which is just the 3% of the base price. Then for underwriter, just go over to the pools section and just choose whether you want to underwrite calls or puts. So let's say if I want to underwrite calls, then just click add liquidity over here. So here is a brief valuation that I have done. Again, as usual, the yellow is the variable inputs, red is the token price, and green is the valuations. So max supply is 100 million, circulating supply is 13%, and right now the token price, let's say, is $1.45. So their treasury value right now is about 22 million, and this is their NAV per Premier, 22 cents. And their monthly revenue right now is about 36,000. So this is based on August daily fees, which is about 1,200. And this is from the Discord channel. They say they're earning roughly 1,200, which was a slower month. So it's actually much higher, I think. And based on today's price with 50% supply stake is corresponding to 5% APR. So you can see over here, the current APR is about 4.6%. And this is the growth rate assumptions. So this is based on their latest blog article. You can see that arbitration volume grew by 24%, Ethereum 31%, and Phantom 49%. And Optimism is a new chain that is just launched this month. So once you key in the growth rate assumptions, you can calculate what is the annualized revenue by the end of 12 months, factoring in the month-on-month growth rate. So the formula is over here. It's just the present value times 1 plus growth rate to the power of 12 minus 1 divided by growth rate. And this is the how many percent is stake. So based on all these yellow variable inputs, this is how much revenue per Premier stake, and this is how much revenue that is extrapolated based on today's figure. So this should be much lower, because this is assuming that this is the constant for the next 12 months. But this is assuming that we are factoring in a 20% month-on-month growth rate. So based on all these inputs, the expected APR by the end of 12 months is around 12%, and this is currently the valuations. So this is based on 13% and 50%. But if you want to be more conservative, let's assume this is 100%, and percent stake maybe is around 80%. Then this is how much use the protocol is actually generating. This is the worst case, most conservative base assumption. But of course, Premia is actually a very, very young growing protocol. They are actually adding a lot of potential revenue streams coming in the line. So they are going to implement a lot of vault strategies, both from the Premia team and the external. So there's going to be some fees charged or something. I'm not sure how they are going to monetize this. And also they are going to partner with market makers protocols after their V3 launch. So right now their focus is really this V3 and re-examining the tokenomics. So everything should be coming around Q4. So this is in a way very similar to Umami. It's both Arbitrum small cap and it's both a Q4 play. So right now already 7 out of 9 core elements are in place, and they are really working hard to ship this new V3 and this new tokenomics. So the new tokenomics is this V Premia, works quite similar to Curve V tokenomics. So you stake V Premia on any chain, and the longer you lock your V Premia, the more rewards you get, the more voting power, and you can redirect the emissions. And right now they are paying about 1.8 million emissions per year for incentivized underwriters, and this amounts to just 1.8% of inflation per year, which is rather immaterial, so I wouldn't worry too much about it. And they also are saying that they might extend this founder allocation for the locking part, but they're going to revise a new tokenomics, which is going to be soon also. Not sure when it will be out. But I think all of these pieces and moving parts will come together in Q4. So for all these valuations to make sense, then you would ask yourself, what monthly revenue should it be? So this August figure is based on a slow month. So let's say if based on normal average month is 50,000, and you need a 10x in monthly revenue for this, right? Because right now it probably doesn't make sense. It's a little bit too expensive. But let's say if it can do a 10x in monthly revenue, then this could be potentially attractive. And this is based on a fully released circulation of 100% and 80% staked. So you can play around with all these assumptions. Just go over to my Notion page. As usual, it's all under personal Excels. And if you want this chart, just come over to these personal sketches. And there are also some strategies that you can play around with. So this is just on the top of my mind that I just came out with. So definitely there are a lot more strategies for those more degen options player out there. But the first strategy is let's say the call pool price is above market. So this means it's attractive to underwrite calls on Premia, right? So you sell calls on Premia, and to hedge yourself against this, you buy calls on Lyra, which is much cheaper because it's a European option. And your exposure is going to be delta neutral. And if your capital gets utilized here, you can potentially earn the premium up difference, because your premiums are actually much higher in step 1 than step 2. And then you can also gain the yields on step 1. So another strategy is, let's say, like cross-chain, like call pool price is above X and below Y. So you can sell calls at X and buy calls at Y. So X and Y being two different chains, because right now this Premia option price is actually different based on different chain, and it is based on the supply and demand for each chain specifically. So there might be a price difference in terms of the options. So you can sell calls at X, buy calls at Y, and your exposure would also be delta neutral. And then another strategy is, let's say you think there will be low volatility environment, so you just sell calls and sell puts at the same time, and your exposure will be sort of like a open scrap or a short strangle, where you hope the price just stays where it is, doesn't move too significantly, and you farm Premia on both sides. And also by underwriting options on Premia in general, you are earning quite a high premium. And the risk is if price pumps either direction, then you lose a lot. So if you want to watch more about this OpenCrep, I have actually done a YouTube over here. You can come over here and check out this OpenSquiff. And here are some like other notes that I have jot down briefly. So long straddles is generally not suitable for American options because your premiums are much more expensive. It's much better to just buy directly on Dopex Atlantic straddles, which I also have done a video that you can check them out. So generally, you want to underwrite calls when price is above market price and buy options when price is below the market price. So this is this C level that we talk about. And it's good to sell calls if you think price is at a resistance, because by selling calls, you are actually betting that price will go down, because if it goes up, you are at a loss. So you just earn the free premium over here. And sell puts if you think the price is at the support bottom or price is attractive. So you are basically betting that price will go up, and if it goes up, you make money over here. And once again, thanks for watching this video. If you find it helpful, we'll appreciate if you can share, like, give a thumbs up, subscribe, and I'll see you in the next one. Bye.